Welcome to the Twomey Stock Market Report. I'm James Twomey, and today's Monday, November 14th, 2022. Well, we certainly had a lot of developments the last couple of days and last week, so turned out to be very, very volatile. I want to get right into our data. We've got a couple of things that are transpiring now. As we've always asked the last couple of weeks, insight on market fundamentals. What's next? We want to look at stocks and review. Overall, we're having a little bit of a battle between fundamentally what's happening in the economy and also what we're seeing technically on our indicators. The fundamentals haven't overall drastically changed. Yeah, we've raised interest rates quite a bit from the Fed, the supply side, from the supply chain end of the spectrum has improved since the COVID issues. But overall, we haven't really changed much on the supply side to affect how the whole fundamental economy is working out there. We still have shortage of energy. We still have a shortage of ability for companies now to move and borrow money at lower rates and pretty much expand at will. We also have Europe with the environmental factors still weighing down, whether it's the energy issues or the Nord Stream or Ukraine or the lack of supplies that are getting in and out of Europe due to the war and a few other constraints. So that's still at bay. Is the world learning to live with that to some extent? And people are now trying to look forward to the next 3 to 6 months potentially and where the market will go and predict that if the Fed does start pausing or reducing rates, I don't see reducing, but they certainly feel like they're going to get closer to the funds rate of 4.5%, 5%. We're basically at 3.754% now. So, there's a little optimism, if you will, and maybe that's what's driving the fundamentals that is bringing people into the market. So, I want to look at what do we know right now? We know the market has been volatile. Last week we had down 600 points after the midterms, then up 1,100 points the next day. We had the NASDAQ coming up 8% last week. Just some tremendous movements off the bottom for that NASDAQ. We saw that, the week before, negative earnings or negative poor revenue on some of these major high-tech firms, and they just fell out of bed stock-wise. And we had a rebound with the CPI number coming in slightly less than they expected. Inflation is still raging. A drop in 0.4% doesn't necessarily mean, wave the white flag, inflation's over. And, even if it comes down, we're still in 7.5% or whatever the number came in at, which is very difficult to navigate, both from the consumer and corporation side. But we do know also what's showing staying power in this particular economy in this in the stock or markets, right? The Dow Jones Industrial Average is no doubt leading that. We're going to go into that a little bit more detail when we get to the technical section. Also, financial and banks showing very good strength finally. That's been predicted for almost the last 12 months because they felt with interest rates they do or fare better. And we're actually starting to see it in their economics, even though people like JP Morgan, Jamie Dimon, and others are coming out saying there's tremendous headwinds it's going to affect, especially when it comes to borrowing and rates. Energy is definitely showing. It's also showing some that points where it's getting tired. We're heading into the winter season. There is shortages in certain parts of the U.S. for diesel and heating oil. That is going to cause some issues down the road. The transition to green is just going to accelerate based on what we found out in the midterms, and even if the House takes over control and get a little bit more of a gridlock situation, and we don't know that for sure, but we feel like that's still going to be the push worldwide, and there isn't a total solution to replace what we have right now, and that's going to cause the same drift that we've been running through where Fossil fuels will probably race forward for quite some time. And if they do decline for a little bit, then we'll make our changes in our energy plays. Real estate and REITs has found a great rebound off the bottom. Don't know if they'll have staying power, but we certainly have seen, especially on the industrial side, maybe people going back into the office. Not really sure if that's that magnitude that we're seeing in the play with REITs, but they're all showing very positive returns. Materials, okay, the dollar has come down quite a bit. It's dropped 7% in the last couple of weeks. That's a major move in the dollar. That helps not only the economy here, but when I say the economy here, it alleviates pressures. A high dollar does a lot with the borrowing capacity, especially overseas. The world does trade in the dollars or buy in the dollars. So if the economy overseas, they have their currency is less than the dollar in value, or it comes down in value to the U.S. dollar. Any debt that they've converted or run in U.S. denomination, they have to kick in more of their currency to cover that, monthly payment, if you will, or interest payment, because their currency is valued less. If the dollar comes down, they get out of that hole a little bit, and they can now a little bit more room to maneuver. Of course, a strong dollar for us, anything overseas looks really less cost to us, as when we have to buy or import. But so we'll see a little bit of a haircut on that side. But as the dollar comes down, typically we've seen a little bit of a bump in the materials, and that's what we're seeing here. We do have a play that we haven't issued a sell signal on it yet. We've got burnt on it a couple of times. I want to see a little bit more and do some more research in that whole sector, but that sector is performing very well. So we've got multiple sectors. If you looked at the market report this weekend, we see that in our sector table how finally the 6-month side of the equation, we're seeing 5 out of the 6 or 6 out of the 5 that are actually showing green for the first time all year, which is a real big momentum push. All right, so I want to go over a little bit more and close out the fundamental sections here. One of the things we talked about, what's happening, right? Economic is much change. I mean, are you seeing changes at the grocery store, changes in your utility bill, changes in gas, changes in high ticket items that you're buying or borrowing, for a mortgage for a home? The answer is clearly no. Everything has gone up. It's not gone up 10% or 7%. In some cases, it's gone up 30, 40%. I was chatting with some folks, and I was saying, I understand cost of goods, cost of services, things are going up, labor's going up, cost of, insurance to provide for your workers. We're in this new age where we're going to take care of our workers a little bit better. But the prices of the services, the bills aren't going up just 7 or 10%. They're going up 30, 40, 50%. And that's, a couple of things going to happen. It's going to cause people to shop to other avenues. And, hopefully competition will come back into play to drive those prices back into something that's more realistic. But that's what we're seeing. We're seeing supply side constraints reduce, but we're not really seeing any changes in how we're going to handle the supply side. And when it comes to energy, we're pushing. It's going to be a stronger push to the green energy side. If it works, great, but there's not a solution yet to replace what we have. So you can't declare a war on what we have until you have a great replacement, and it's not coming overnight, and that's going to be a problem. And that goes also with whether it's taxation or whether it's obviously competition. Are we doing things that are going to bring in more competition or restrict competition? And that's a bigger picture that's causing some of the problems. We're also seeing government spending. Will it abate? They've passed 3 major bills. Trillions of dollars are in the economy. It's just starting to hit in some cases. Some of it won't hit for another year or so. But that is, all those factors are still inflationary. So if we look at this graph to get to the bottom of the line here, the green is the U.S. Fed's fund rate. The blue is the CPI, which we track. We know where it is. if we look here, this is an interesting graph because 2016 to 2020, before COVID hit, you can see the CPI, even though it was still respectable, below 2 and not quite 2.5, but it did peak a little bit here, in 2000 and late 18. But what happens? The Fed was adjusting rates. As the Fed brought up the green graph here, brought up the rates, and CPI continued to run ahead, and not until the Fed started flattening out on its rate increases did we see a flattening out of the CPI. So which came first? Well, obviously the CPI was higher. The Fed raced to the rescue. It took a while for that all to take effect. Again, this is just the demand side of the equation. Other things on the supply side may or may not have changed. So, but we're just looking at the demand side. Then it looks like the Fed said, all right, great, looks like we've got the data's coming in, and they started leveling off, and then the CPI then started to fall. So what does that tell us? We probably have to wait until the Fed is actually flattened out on their rate increases. And we've said that before, but that's kind of the time where we say it's safe to go into the back market or go back all in and probably start picking a lot of our mutual funds, et cetera. But if we look to the right of that and look at the CPI blue, we obviously feel and know it's way up here at the top, at the peaks, right? If you look at the Fed funds rate, it just really started halfway into this really magnitude of scale. Lots of reasons why it happened. And we're only halfway there with our Fed, not even quite halfway of our Fed fund rates. In the green graph to the blue, there's still a tremendous amount of gap. So as the gap narrowed here, we saw the Fed level off. We don't see a close gap here at all. So it looks like something's going to change. So either the Fed, if it does raise another point or so between the next 3 to 6 months or less, it starts leveling out. Will CPI start coming down rapidly? Hard to say, but that's still 3, 6, 12 months out. So this appears on the surface that inflation is going to be here for some time at elevated numbers, and we're not going to get to that halving point of 4% that the Fed's looking for, probably well into next year, 2023. I'm not in the prediction business. We're going to let the data tell us and show us where we go, but I think it's a little premature for to see the market rush ahead based on the fact they think hey, the Fed's going to 0.5% in December, and then the first quarter next year they may not even have to raise. But we'll see, and we'll let them look at the brighter minds look at that, and we'll play it. But in the meantime, we're seeing some things change fundamentally. Yes, a little bit. Technically, tremendous difference. Technical indicators have all improved across the board. The short-term oscillator, we watch stochastics in our indices and major stocks are way up into the positive territory. We'll go over some of those numbers. It took all of October to get off the floor, and now they're up over 75, 85, in some cases 95. That tells us short-term prices are certain, and it oscillates quickly, right? But it does tell us, hey, prices are on the advance. The more convergent divergent MACD is a little bit slower oscillator. It doesn't change as rapidly. That again is over positive territory. It was all negative territory for quite a bit of time. It's some of our indices is 3 or 4 on the positive side for the green line. I mean that's been a tremendous change. Advanced decline and a CBOE. CBOE is the puts call ratios. It is 0.55. It was up at 0.77. Most recently, so this is definitely in a more bullish sentiment, and that changes, week to week. We do post it, but it's not the end-all, be-all number. But the one I really take a long look at is the advanced decline, and I'm going to see if I can pull that up here right now. Yeah, there we go. Advanced decline chart. This is the daily chart, right? A couple of things to look. All right, so down here. Early October to mid-October, we're at the bottom, and that's more advances than declines. So you can see this. This isn't a year picture, but from June, it pretty much has been a downward slope, and of course, been a downward slope all year. And at the end of October, it started advancing. We saw some good advances. We say, hey, that's pretty good, but it's now crossed above our 50 EMA, which it takes a lot of notice out. And we've done this before, and we've quickly reversed. Right, this one was a little bit elongated in the summer bear market rally, and this sloping is showing some great signs. In addition to that, we're quite a ways from the 200 EMA, which is, if we get above and stay above that, it's technically a much stronger, healthier market. We did that in the bear market rally. As soon as we got there, we reversed, and it was down, down, down. So, these are all resistance areas technically on the chart. We happen to get above the 50, even it looks like it's going strong. The difference here is we've got our MACD it's moved up very high and into almost positive territory. We've also have the relative strength index quite high. I believe it's in 67.5%. No, it's 59. Right, so we're in a good breath. The market is going strong. What's more important, I look at the advanced decline chart as a little bit more of a longer picture, even though this is a day-to-day view. It takes a lot of momentum to push these forward. If you look at a day-to-day, it doesn't tell you much, but if you start taking a snapshot month to month and you say, hey, well, we've got a trend developing, right? Will it stay? That's when you be, active traders, that's what they're trying to predict, right? Especially from a technical perspective. We don't want to be reactive traders. We want to find the trend and jump in the trend. So the trend is off and it's running up. We know that. The other thing that I noticed was I tracked the 200 EMA, the number of New York Stock Exchange stocks trading above and below certain indicators. 200 EMA is one that is really, anything below that is really telling you some negativity is mounting. Well, we've been as low as 81%, and during the last financial crisis, it was 100% below the 200, trading below their individual 200 EMAs. Well, we are now at 56.4%. So almost half of the stocks have recovered above that 200 EMA. That's given us what they term breadth in the market. It means more people are participating, a little bit healthier. It was 81% not that long ago during the parts of the summer, and after the summer bear market rally in the last month or so. So we've come a great distance from 81% trading below to 56% up. And last week it was 67. So we're starting to see some quick movements. And of course we had some volatility last week, and markets ended up pretty strong last week. So what is that telling us? That's confirming technically that the trends are on the march in the forward, and it can reverse any day now. I mean, this is the way. If you're a reactive trader, anything can happen in 24 hours, right? We're going to review some of the charts. We're going to look at some of our alerts that we went over. But if we look at I want to go over a couple of things again on the technical. This is a daily SPY that we use for the S&P, right? A couple of things right off the bat. We talked about stochastics, right? They're up in the 90s. The green is above the red. A little bit of flattening out yesterday, but all in all, very healthy. And you can see it took all month of October, even though it raced up here. It was up and down, up and down. It took a while for it to really get into this level, right? October, and prior to that, it was all pretty low. MACD, which is our slower oscillator, convergent, divergent. The green is now above the red again, even though it took all most of from the bottoms of September, most of October to get up, but it's up over zero now. It's positive, and the green is reading of 4.77, which is very aggressive. So that's telling us that's a longer indicator that we should be going towards advance. We look up at the daily chart up here, a couple of things. The Twomey trend track line, again, stocks don't know anything about my track lines, but we are bumping up above that. The RSI is 60.91, and it closed last week a little bit higher than that. But anyways, what's that telling us? We may be running into some resistance. It's also bumping up to the 200 EMA, and this is very important because we're going to go to the Dow and it's going to do a comparison analysis. But bump up to 200. Will that be resistance? Typically, it has been in the past. But what we see here below that's for support. We've got the 9 EMA, the 14 EMA, we've got the 50 EMA. These are all technically support areas. A lot of traders, once the 50 is crossed, they'll start, trading and investing and saying things are moved up in a once it's over the 50 EMA, it'll bring in a lot of technical traders. And you can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, about 15 trading days, we've bumped up and down around this 50 EMA, and now we not only closed above it, but we're also now racing above it. We're now testing the 200. So we expect the 200 to act very similar to what the 50 did down here, but that's, again, we're not in the prediction business. Let's see where it's going. Very healthy. But so keep that in mind, the 200 and the 50. I want to go to the diamonds, and that's been leading the charge, and that's what kind of, we did get into a lot of our material plays, not material, industrial plays. But look at here. Of course, the Dow is almost up to the bear market rally here. But see here, the 50 way down here, right? And look at the 200. It came up. It bumped off the 50 here, and then it crossed above it, and then it went right to the 200, and it broke through it. And a couple of days it came back down, and then it raced above, well above on our, and look at the 9 EMA and the 14 EMA are also above the 200. That's very positive. It's flattening out a little bit now, but it's still at the lower end of the Twomey trend track line. So it does foretell advance, and we'll see how that goes. If that continues to lead, then the S&P and the NASDAQ may be following suit, because investors will say, hey, it's safe here in some of these more, and it makes sense. I mean, the market was beaten down, and tech companies look terrible, and people were kind of feeling that the money was coming into the infrastructure and other bills, and they felt the Fed may not be raising rates as fast. They said, hey, it's probably safer to go in the market. Let's go into safer areas, and industrials, big, well-run companies tend to be safer, right? They pay dividends. They can convince their investors it's not a bad place to go because you get a 3% or a 5% dividend, etc. If we look at the MACD here, the MACD is at 7.7, right? Now the SPY, we're going to go back. So we've got, keep this picture. We've got 7.7 in the MACD. We've got the 50 EMA here, the 200 EMA, and our short-term technicals, 9 and 14 above the 200. We're going to go back to the SPY, and this is what I've been watching. If we look, the 200 is, we haven't crossed the 200 yet. We're playing with it now. We're above the 50. The 9 and the 14 just crossed above the 50 just recently. There's weakness here, and the other companies have to catch up. But we're almost half of the New York Stock Exchange is in and above their 200 EMA. We flip that to the 45s. These other sectors are going to come racing along. We use XLK for our high-tech sector. We got flushed out of that. We went short and we got flushed out of that. So we got another buy signal registering there. We're above the 50, closed above the 50. Again, toyed with the 50 for a while. That's a very positive indicator. It hasn't brought in as many technical traders as I expected, but we will see. Of course, that's because the tech sector is still, Amazon just announced they're going to lay off 11,000 people, or 10,000. Meta said 11,000. Twitter, obviously, we know what's going on there. As they privatize that company, they've got to cut costs and alike. So we're seeing this divergence between fundamentals. Things are kind of changing, but not really. And then inflation's still here, but yet we're seeing stocks come back in force and in charge, right? So we want to look at TBT. That's one of our holdings. We had 44%, 38%. We just sold our last position at 36 or 34%. Our added position, we took a haircut of -6%, 6.5%. But all in all, since early August buys and mid-August buys, we're well into the high 30s for a nice return, low 40s. We'll take that every single day. We got the sell signal here. We can tell the stochastics are down at the bottom here, negative territory, green below the red. That's our fast oscillator. We got multiple sell signals on that throughout the last couple of weeks. MACD, we got a couple of sell signals as well. And sure enough, here we are at a 0.82 on the green, and it's starting hitting down into below zero. Definitely that negative slope has developed, right, for the last couple of weeks. We're well below all our technical indicators, and will it level off here and come back in and rebound? Let's just go back here when we played this all year, and from early part of the year, and it raced up. We had a couple of inflection points that we had to be careful of, and it raced back up. So but in the summer bear market rally, we saw quite a bit of a drop of. It was at that time trading at in 27, 28, 29 and a half, excuse me, and it went all the way down to 24. So we don't want to lose 20% of our position after we gain 30-40%. We can always get back in, and we're going to just see how this plays out. I want to look at the weekly chart on that, give us a little bit bigger macro view. And what's interesting here is we haven't even crossed our 9 EMA, and our MACD is still well into healthy territory of 3 and above the red. And of course, our faster, no surprise here, our faster stochastic is turned down, and it's 66, 68 on the green, which is still not too bad after being up some lofty goals. But this is maybe just a short-term pullback, because we had our whole early discussion about our rates, right, and where they're going. So we're going to watch that. We're going to protect profits. If it takes off, we'll get back in. PSQ, we had to get out. We didn't do so well. We got a quick buy signal, and we got a quick sell signal, so we're out. Very disappointing trade, and it's heading down to the 200 EMA. Will that bounce off of that? Hard to say, but the stochastics well down near, almost near 10. The MACD is negative. The all our technicals are negative, well below the 50, and that was a couple of day turnaround, mostly for CPI. So we got caught in the backwash of a reaction trade, which is not our style, but our job is to protect profits, and we want to make sure that the rest of our plays put our efforts into the plays that are going to know that are going to give us money. XOM is still doing well. We talked about energy starting to flatten out. It's really abuttoning the Twomey trend track line. It has done that for the last 10 days. We've gotten into the high RSI. We've seen that extended in TBT for quite some time once a trend's established. So we're going to keep our eye on this. It's kind of getting near fundamentally its peak. Maybe I'll do that in one of these market letters to see, but we're in pretty good shape there. I'm going to look at XLE. XLE is another one, and this one has also had that narrowing cone, and we're getting a little bit flattening, but it's not doing so bad. I noticed, so we're going to watch that, but again, well above the 200. Well, this is another example, even though it's, the energy trade has been terrific this year, right? But, it's been above the 200. Once it gets above that and maintains that, it stays above that, it's usually a longer trend run, right? The 50, it has played with the 50 off and on, but it stayed pretty positive, and now we're well above that. So it's got some strength. We may be getting into a little bit of a peak there. I want to look at another one, CPG, we've been in and out over the time. This one is starting to flatten out. That's our pipeline one that we had played a little bit. It just gave a dividend. I've been keeping my eye on this one. It's had a buy signal for a while. So we're going to take a look at that potentially if that may come back into vogue. I'm not 100% sure for that. And lastly, materials. Let's look at the gold miners. We like to look at the gold miners ETF, and that is up against the 200 EMA. Had a nice run. We got a buy signal. They did not issue it just because materials are we had enough that we were working with that I felt that as far as risk, and I didn't. Materials, especially silver, gold, all those type of things are very risky. You can wake up and be down 10% overnight, and for no reason at all. It's a tough trade to play in. The gold miners are a little less fluctuation, but I want to see how it reacts here. There's plenty of room. There's plenty of room for this go. If you look from the way highs way back here in May, we're only bounced up off of that. We haven't even reached the 0.382 retracement on Fibonacci. Again, I'm not the Fibonacci king here, but I do use it in a magnitude type scale and with some other. And again, we're here talking on the technical trade side. We really make our decision. I'll repeat myself about it fundamentally in economics and what's happening. And then we try to look at our sector tables and we narrow it down and we start picking either ETFs or stocks. And then we play from there. Elongated trends, we start moving more towards mutual funds and some other things to park our money. I'm always looking for places to park our money. Also, I sent out so this is where, gold may be a place that's going to be a little bit of a risk trade run for us. I did send out Vanguard BSV. I had sent out a correction on that to our subscribers. Vanguard short-term bond. We always look for places to park money during changes. We're seeing fluctuation. If yields flatten out, TBT doesn't, run as we have been used to. Is it safe to go into long-term bonds? Probably not. But short-term bonds, I've been buying the 6-month bonds just to park some money. Long term, right now, if you roll those over, I was running around 4.11% year over year. If I roll them over, they've increased the last 6 months, so it's been an odd place to put some money in and not have to worry about it. And so I've been hunting for something in the BSV. This is something that I think we can park our money in for a while. I don't expect it to race off too much, but stochastics positive, way up. MACD, the green is, I think it's in 12, so it's way up there, and we're above the 50. And I'm looking at the 50 being a trading number. Every time we get up to the 50 this past year, it's failed, right? It's failed. So we're at that inflection point. We've got some positives here, but it's got to hold, and if it doesn't, we'll get out. So that's something that we want. We have not expected funds like this short term, anyways, to garnish a lot of gains. I think it's got a 3% dividend, but I'll have to double check that. But if yields flatten out, this may work as a nice place to get a few points. And we'll check it out. We'll keep our eye on it. See, anything else we wanted to cover? No, that covers it. So keep abreast of the Twomey Stock Market Report alerts, and of course the newsletter we've just updated. We sent that out to subscribers. For anyone that hasn't got that, go to the website TwoMeStocks.com. That's the number 2 MEStocks.com, and therefore there you can sign up, get all the alerts. You get our market report. It's 21 pages or so every week. We also provide the trade tracker. You compare the recent trades, the past trades, and we're in a situation here that we're trying to get us into a more of a trend trade versus a reactive trade. And right now the market's very reactive, so we have to be cautious, and we want to make our plays accordingly. So I'm James Twomey. Today's November 14th, 2022. We'll get this posted to the site. Happy trading. And don't forget, check out TwomeyStocks.com. Thank you.